So, on the 3rd of February, the Bank of England raised their base rate for the second month on the trot to 0.5%. Now, this is kind of a big deal because it's the first time since 2004 that the Bank of England has raised its base rate twice in 2 consecutive months. Now, I actually went on record back in October, November time stating that I really didn't think that as the Bank of England had raised their base rate in November, that they were likely to do so in December or January. I was wrong, hold my hands up. I actually thought, given it's December and January, December being a month where lots of people spend lots of money with Christmas, and then January being a month where people kind of tighten the purse strings, that they wouldn't do this. Okay, I was wrong, I hold my hands up. They raised the base rate from 0.1 to 0.25% back in January, and then we got our second increase just now in February to 0.5%. Now, in terms of what this means to the mortgage market, and for those of you watching that are property investors or homeowners thinking about what to do with your mortgage, when the rate increase happened in January to 0.25, everyone straight away was, what's going to happen to mortgage rates? Now, in terms of what actually happened, there wasn't anything to be alarmed by. It wasn't a big enough increase in the Bank of England base rate to allow or to make mortgage lenders really take much notice at all. At the beginning of every single year, every single mortgage lender has targets and projections for the year of how much they want to lend, and they will change their criteria and they'll change their interest rates based on how the economy is looking and how they think they can best bring in the new loan applications to help them sort of get to their overall targets for the year. When the Bank of England base rate went up to 0.25, there wasn't a significant enough increase to actually stimulate any change to what I believe was the lender's sort of natural ebb and flow of raising and lowering interest rates to try and meet their targets. We saw some lenders in January actually decrease their rate, and it has actually shown so far in February as well to be the case. Lots of lenders still decreasing rates. One of the big ones in our industry as investors, Kent Reliance, back in the market after a little bit of time out with actually bringing in a market leading 2-year fixed rate in the limited company sector. But what's going to happen now that we've seen another increase up to 0.5%? Well, look, let's be honestly realistic, people. In the grand scheme of things, this isn't the biggest interest rate rise that we've ever seen, nor will we ever see. And we are only still at 0.5%. It's still incredibly low traditionally. And I don't think there's going to be a massive knee-jerk reaction in the short term. But there's something we need to worry about. I saw in The Guardian, on The Guardian's website yesterday, that actually out of the 9 members of the Monetary Policy Committee, who are basically the people that decide whether the interest rates are going to go up or down, of those 9 individuals, 4 out of those 9 actually voted for the increase to go to 0.75%. So actually, we were pretty close to that interest rate being higher than 0.5. We were really close to it being 0.75%, a big increase. And actually, in terms of a percentage increase, really high, even by traditional standards. And this might have had a really big immediate knee-jerk reaction within the lending market to suddenly see a whole spate of changes to products and a massive increase in terms of overall products. Now, it's good that we didn't, because I believe that a big change very quickly can often lead to a knee-jerk reaction that actually isn't necessarily good. But what this does tell us is that although this month I am predicting that we're not going to see lenders increasing their rates en masse hugely, we have seen a couple of minor changes even in the last 24 hours. But obviously we've got to let this rate increase bed in a little bit. But what I am predicting is that there is a pretty good chance that in March we're going to see a further increase, potentially up to 0.75. It is at that point that I think we are going to start seeing a larger number of lenders start re-releasing products at a higher interest rate. So what does that mean to you guys, the mortgage owners, the mortgage applicants? Well, now might be the time to tie yourself in to some long-term interest rates. By the way, guys, all information that I'm passing on is not actually advice. Advice is when there is an advisor and an individual, and that advice is bespoke. Obviously, I'm hopefully speaking to many hundreds of you watching this video. It is not bespoke advice. I'm just giving my opinion on these things. But if you are looking to refinance over the next few months, maybe you're in your last year of your fixed period, I think it's a good idea to review your current situation and see whether actually paying the early repayment charge might actually work in your favor if there are rates on the market at the moment that would mean that you would save greater or equal to the amount that you would pay in terms of your early repayment charge. Because what this means is anything over and above that is an instant saving. If you can tie yourself into a lower interest rate for say 5 or even in some instances 7 years on a fixed rate, this would safeguard you against future rate rises and allow you to sleep soundly, for quite a number of years to come. And if you're an investor, that means that you are going to lock in your cash flow. And you know what? With rises in everything, the cost of living going up massively at the moment, who's to say that over that period of time you won't see a decent rise in your rent, but you will not see a reasonable rise in your rent, and you will not see a reasonable rise in your mortgage payments per month, because they're going to be locked in for a long period of time. So now might be the best time to actually review this. There's also going to be some of you that are only a matter of months away from when your fixed rate actually finishes. And to be honest with you, even if you're within 6 months, it's actually still worth starting the process sooner rather than later. And here's why. When you actually apply for a mortgage, you lock in the rate. So what we're doing with a lot of our clients at the moment is we're starting the process. We're getting a decision in principle and we're applying for the mortgage. We're actually sending in the full application to a lender to lock the rate in. Now, usually I am the biggest advocate of speed there is. My team knows me very, very well that I am constantly pushing the boundaries of how quickly we can actually get mortgage applications through for our clients. However, in this instance, I've got to put all of those thoughts out of the window, because actually what we want to do is we want to slow down the application process. Most of the time, mortgage offers are valid for 3 months. And what that means is that if we actually go through the application process, we get a valuation, we get an offer, as long as that happens less than 3 months to go until the end of your fixed rate, we can just sit on that offer and then we can complete when your fixed rate runs out, and there'll be no early repayment charges to make. Generally speaking, we try and get our applications to offer within about a 3 to 4 week period. If we really long it out, we can make that probably 2 months. Any longer than that, it's a little bit difficult. But don't forget, if you're refinancing, you are in control of the mortgage valuation and when that takes place as well. There is nothing stopping you playing the game a little bit, and when we get to the point of valuation, which we won't instruct until all the underwriting has been done, and we can probably long that out a little bit as well, you can actually, if we do feel that that's happening a little bit too soon, we can always cancel and rebook for a couple of weeks later. Those kinds of things do happen, trust me. Sometimes the surveyors actually do that themselves if they're too busy. So there are ways and means that we can actually elongate the process of applying for a loan that makes it so that the offer is within the 3-month period, so that there's no early repayment charges to make. So there you have it, guys. A bit of a quick video today. I needed to get this out nice and quick because obviously, old news is old news, and I wanted to get this out while it's still fresh so you guys knew what the implications were of the increase in the Bank of England base rate, and then of course how that potentially was going to reflect in the months to come, and what impact that was going to have on the mortgage market and potentially you as the consumer, as the mortgage applicants. If you have any questions related to this, don't forget to drop them in the comments below. And if you have enjoyed this video, please don't forget to like and subscribe it. It tells YouTube that I'm doing a good job, and hopefully that will allow me to grow the channel as well. But anyway, thanks very much for watching, guys. I'll catch you on the next video.